Hey everybody, this is Paul doing a dividend related video. So I just kind of wanted to go over the portfolio, just different things that have gone on in the last 2 weeks. I'm recording this today because the 15th is on Monday, so nothing really going to change my portfolio between now and then. You know, it's just, this is kind of the amount that it's going to be right now, so I thought this would be a good day to do this. And we kind of have a general idea of what's going on in this market. So I guess let's look at the big data that came out. So the market continues its sideways motion basically. It has traded in a remarkably in an incredible range. We have not moved pretty much out of this range right here. You can kind of see it right here. So see this 38.61 right here and this 41.71. We have been in that range, except for this period right here, obviously, where a lot of people think we bottomed. But we've not gone below the October lows. But this market has been in a range, in a pretty incredible range, since pretty much November. So that's certainly something right there. But so why is it doing this? The simple fact is if you go over to the bond market, it's just pretty simple to see what's going on. Look at this right here. This is insane. This right here is only going to pull more money. That's only going to pull more money out of regional banks. This right here is 100% related to the debt ceiling, debt default kind of stuff. And you can kind of see what the bond market's doing, 5% or higher, that kind of stuff. In an average, I believe a lot of people quote this number, but in the last 100 years, your average return on the stock market is 7%. Well, guess what? You're getting 5% right here. You know, you're about to get 6% right here if this insanity continues. The closer that we get to the debt ceiling, the higher this number is going to go, and the more people that are going to pile into money market funds. Personally, I pulled out of my own money market fund, so I can go over to my spreadsheet and show you. So I pulled all the money out of there. What's the reason? Very simple. E-Trade told me I couldn't contribute any more money because I live in the state of Louisiana. This is the message that I got when I tried to add more money. Fortunately, this fund cannot be sold to a resident of the state where your account is registered. I called E-Trade and they have no clue why. Nobody actually knows. So I took that as I need to get out of this real fast if I can't control my own money kind of situation. So where did I put the money? Very simple. So as I told you in previous videos, I upped the amount that I want my portfolio to be for this right here for AFB, which is my municipal bond mutual fund, up to 25. So I took this from basically 21 to almost 25% in one go. And then from there, I've just been adding money as my portfolio demands. So eventually, I want to get BST up to 10%, even though that's not really too much of a priority. My priority is this right here, that O, for example, and then I'll kind of focus on BST. And then for BSTZ, obviously, I'm past where the 5% that I wanted. Um, so what's and then also one thing you may notice also on my sheet here is this is the stuff that nobody else really includes on their dividend videos ever. So I consolidated all my money, all my loans into a much lower rate. So as you can see here, right here, for example. So I consolidated all of that into one payment and then I also got it at a remarkably lower rate. Because it turns out that even though regional banks are like cutting back on the amount of loans that they're doing, the bigger companies, if you look at their things that they send you and you actually kind of check into them, they're snatching up prime borrowers. So if you have a high credit score, the bigger banks are actually trying to get your business because they effectively smell blood in the water. They know that people with high credit scores are still looking for credit because they want to continue doing their daily lives, consolidating debt, taking out loans for cars, that kind of stuff. And regional banks are cutting back. So, because they're obviously under attack by short sellers and everybody in the book right here, you can kind of see, just these different regional banks that were down yesterday. So, there's still lending going on. It's just not from the smaller guys, really. I imagine it would be pretty hard to walk into a bank right now and get a loan. It could be harder. So that's kind of what's going on with the portfolio. Consolidated some debt into a much lower payment per month at a much, much lower rate. So that frees up more money to invest, obviously, and it gives me more of a cushion in case something happens. And then also took the money market fund specifically and put it over here. I do still have this money market fund that I might start adding money into, as I don't think there's any restrictions for Louisiana. Um, I have not tried to add money, but there might be some weird restriction for Louisiana. I don't know. I still haven't figured out why E-Trade did that. They can't even tell me. Um, so let's look at the CPI report as to what's going on here. So we got the month over month CPI report. Um, so as you can see, came in at 4.9. It is very quickly falling, and I believe it's going to actually start to fall much, much quicker. And it's the single biggest reason and the biggest contributor is if you stick these two on top of each other. These are the shelter metrics. So if you take the CPI with current data, this is current data that's coming from like Zillow, that kind of stuff, just the different places that quote rents. If you take the current data, you can kind of see what is going on here. And this is clearly what the market reacting to, and this is actually why the market's rallying, even though rates are higher. As you can see OER, which is shelter, went up, went up, went up, peaked. And you can see it's right here, for example, went up. But when you take the current data and if you read the actual BLS report, they literally tell you that shelter is 40%. I believe it's 40% of the CPI report is contributing to most. Everything else is pretty much, a lot of this stuff is negative. And then if you look at gasoline, it says it was up 3% or whatever here, or 3 points. It's the price of oil or the price of gas because of the OPEC cuts went up to like say $77 a barrel. It's back down to 71 because you can kind of look at it right here. So everything that OPEC did literally got reversed. So you can see right here, see how it's barely at 71. So even after all those cuts, they tried to get it back up to like I think $80 a barrel, and it didn't work. Um, so we have definite disinflation going on, and then you can kind of see another thing that's going on here too. So you see used cars and trucks. So if you pay attention to a lot of the different YouTubers, I think there's a guy named Car Deals guy. There's just different people that Lucky Lopez, for example, is a really good one. These are guys who are actual dealers of vehicles, and they make YouTube videos giving you a very inside look at how the car dealership business works. It's a weird YouTube niche, I guess, but it works because it's especially when it comes down to inflation, it's very useful. And what they basically will tell you is that dealers did what they normally do, is they loaded up on inventory thinking that there was going to be a big tax boom, like tax demand kind of thing, because they're like Pavlovian dogs. They got trained over the last 2 years that every time that you get to this point in the year, you load up on inventory and then inventory goes out the door. The problem is that the people who finance that inventory to get it off their floor and give those loans to those subprime borrowers are the regional banks, are the people that are currently under attack right now. Capital One, these big lenders. And if you listen to these guys who are doing this stuff for a living, they are telling you that a lot of these lenders are cracking down hard on subprime borrowers. So what the dealers did is they bought a lot of supply, and you can kind of see it's just a straight up. So the biggest contributors would drove this number even up at all was cars and shelter. Shelter is coming down like a rock, and then cars is a complete anomaly, as you can see. So there's a chance that this might be down next month, but these dealers have, I think, and they don't start to care until I think it is like 30 or 45 days of sitting on the lot, and then they try to like just sell it at whatever price they can. So that's currently where we're at. The regionals are fighting back, though. As you can see, these are things that I'm getting in the mail. This is actually from First Horizon, one of the banks that's actually like under attack. by the short sellers. So if you go to FHN, this is a local Louisiana bank. You can kind of see it's down today, but you know, this is a bank that's currently under attack by the short sellers, and they just have problems. These banks are just clearly under attack. They have the capital to do it. If you look at a lot of the guys on Twitter, they're kind of looking at it. None of them can really explain what's even causing this. It's not a flight of depositor. It's more the flight of stockholders, which leads to depositors being worried about what's going on. So definitely got to look at that. So that's something you have to pay attention to because it's not stopping. Um, it isn't going to stop until these rates come down. And the real simple reason why is you might be asking, well, okay, well the Fed funds rate, they raised the Fed funds rate again, is at 5.25, but the bond market is at, so this is another discussion that we need to have. So the bond market is like the 2 year is at 3.92, but the Fed funds rate is at 5.25. Well, what's going on? What's that big difference? Why are people still inside of like, what's going on? Where's the repo money coming from? So if you open your money market fund, you will notice that none of these funds are actually invested, well, some of them are, in treasury notes. They're all reverse repos. So reverse repos is basically banks take money to the Fed and they get the effective fund rate, which is 5.25%. The money stays at the Fed and then it goes back overnight, basically. You can look at reverse repos, but that's effectively how they work. They're going to the Fed window. They're getting the effective funds rate, not the actual funds rate right now, because the actual funds rate or the actual rate right now is like 3.92. But everybody's piling into money market funds, and that's why you're getting almost a 5.5% return and take no risk whatsoever. So that's where everybody's piling into money markets funds. It's just gonna keep happening until they close the reverse. If they close the reverse repo, you would see your money market fund drop by a dramatic amount. But the problem is, all that money would flow back into the market, which would make everybody, which the Fed thinks would cause massive inflation because they don't understand how the market works. But so where are we at? I guess so. These are just the different indicators that show if we're in a recession. None of them are flagging recession right now. Nothing is. Is there some kind of? This is something that I saw earlier, and I believe I took a screenshot of it. At least I hope I took a screenshot of it. Well, I did take a screenshot of it, but it's around here somewhere. Let me show you. So this is the big thing going on in the markets right now. Fed, no rate cuts for 2023. Market, 75% of odds of rate cut by September. If this starts to get priced out as no rate cuts, this goes down back into that range, into that 4,000. Like it starts to go down. Warren Buffett said rate hikes are like gravity on the stock market. That's effectively how you can think about it. Higher rates go, the more pressure gets put on earnings and the debt that companies have to take on, that kind of thing. So it affects their earnings. So the market value goes down. It's all algorithm based too. So if for some reason this right here starts to go like, say if this, for example, if this actually started to like reflect the effective funds rate and for somehow got up to 5%, you would see this market sell off like there's no tomorrow. But it's not going to happen because this is going to keep getting pushed out. It's I don't know how to, it's so weird how the market works, but the market is going to keep pushing this data out. So as like once we get to September and they still haven't cut and there's no crash or whatever, but we're still sitting above the Fed's inflation target, there's no cuts, they're just going to push the date out even further. I think that's kind of what the market is doing because that's what the market has been doing since November. Because if this situation had played out already, the market should be much lower. But what's going on right now is as this rate goes up, the more pension funds that do not want to be exposed to the market pile into the funds. The more that the short-term rates go up, the more that money markets pile into the bond market. So there's money that's there. It's piling into the bond market, which is just something that hasn't happened in more than a decade because of the rates have sucked. They've been horrible. So where are we headed? I think we continue to trade sideways. That's just kind of what it looks like. Every graph that you can kind of look at kind of tells you, we're just trading sideways. The market's going to tread water, I believe, in this range for a while. There's really no catalyst to break the market out of this because right now it's effectively the S&P 5, not the S&P 500. It's the S&P 5. There's really five stocks that are carrying the weight of pretty much the entire market right now. It's crazy if you think about it. So, and then there's so much money that has no reason whatsoever. You can kind of see right here, Emirates, average rate, bank deposit average rate. Like, there's just money that's just completely piled into these money market funds, and I don't blame them. The only reason I stopped contributing right now is because E-Trade screwed me on the money market fund. I might find another one, but I have a longer term plan past this year, so I'm perfectly fine putting money over here, kind of stuff. So that's kind of where I'm at right now. Um, like I said, if you're a higher credit borrower, if you're, the regional banks are giving you problems, like if you're in the 720 to 800 range, and the regional banks are giving you problems, like they're not giving you like, percents that you think you should be qualified for, go look at the bigger banks, like Chase, Goldman, any of the banks that have like, globally systemic status. They're trying to attract business right now, and they're trying to attract business in a very big way. Like, so while the regional banks are trying to offer you like 14%, or like even credit unions are trying to screw you with a 14% loan or whatever, go look at the regional banks, because I just got an 8.99%, loan to like consolidate some debt because I got like a bunch of dental stuff going on. So, and I'll have more going on Monday when I gotta, go, get a permanent tooth like replaced and all that stuff. So definitely go look at that. And then, like I said, leave comments. Let me know what y'all think, and y'all have a nice day.